Our closing keynote speaker today is a friend of mine, Matt Harris. He also happens to be my boss, so as a board member of Moov. Matt's been in this thing called fintech since it used to be called financial services. So he just told me 1997 was when he started investing into this space. And so we thought it would be a kind of this incredible opportunity to lean on Matt's history in investing into the fintech space over the last couple decades. A fun fact about Matt Harris is that he has more kids than me. I have 4 kids. He has 6. I have a Yukon XL. He has a Sprinter van. So if we put our 2 families together for dinner, the waiter would be super excited about the mandatory gratuity. And so with that, I want to, if you guys can all give a warm welcome to my friend, my board member, and pioneer of venture investing in financial services, Matt Harris.
Thank you, Wade. Thank you all for being here and for having me. Let's see, I've got a cool hour to fill here, and I'm really excited about that. We got a lot of ground to cover. So here's what I want to do today. I'm going to start and just be on this slide for the next 15 minutes, so don't get stressed out. I'm going to do a little bit of a history of fintech because my sense is there's a lot of people in this audience who actually care about this subject matter and aren't just sort of like doing it because it's hot or because it's interesting, but because you share some of the values that Wade and I share about actually transforming financial systems to make life better. So I'm going to talk about that. I'm going to talk about what I've seen over the past 27 years in financial services and fintech. And then I'm going to talk about what's happening right now. What I'm seeing from the big banks, what I'm seeing from fintech founders, and a little bit of a prediction about what the next few years might bring. So buckle up. We've got an hour together. This is going to be fun. I started my career at Bain Capital in 1995. Bain Capital is an investment firm based in Boston. When I joined, it was 10 years old, 25 people, run by a guy named Mitt Romney, who went on to get into politics. And I was just a young analyst doing deals, and then we stumbled across this credit bureau. There are 3 credit bureaus in the United States that matter at all. And one of them, in the mid-90s, was owned by an auto parts conglomerate called TRW, based out of Cleveland. They had no business being in financial services. Credit bureaus are actually, there's a lot of technology in a credit bureau, which they knew nothing about. I'm sure they were tremendous at auto parts. I will grant them that, but they knew nothing about this business, and so we bought it from them. And I went and lived in Orange County for a year to try to fix this credit bureau. And the first thing we did was change its name from TRW Credit to Experian, which was maybe not a great name, but a much better name than TRW Credit. And within a year, we had done a huge amount of change in that business, and we ended up selling it. It was an incredible investment. I was 24 years old, and I said to myself, I don't like private equity at all. I don't like having to sell that company, but I really liked fixing it and working on it. So how can I just do that part of the job? Decided to get into venture capital. And so I've spent the rest of my career, first for 15 years running my own venture firm, and then for the last 12 back at Bain Capital. The entire time focused on helping founders build great companies. You know, Wade referred to me as his boss. I would say it's more like I'm a service provider because the founders and the teams are the stars of the show, and it's our job as investors just to try to make them be as effective as they can be, as ambitious as they can be, and reach their objectives. So this Experian is transformational experience that I had there. When I started my own venture firm, I said, you know what, I liked that. I liked the complexity of financial services, and I like the fact that helping people get credit more efficiently is something that you can feel really good about. And then frankly, in financial services, if you do it right, there's a lot you can feel good about. You can, moving money around more quickly, less expensively, helps the citizens of this country and the businesses so much in lending and insurance and asset management, wealth management, if you do it right, is so beneficial for our society. And so that has been a huge motivating force, I think really for many of us who've dedicated our lives to this concept of innovation in financial services. But when I got started on it, one of the things I observed is that in the first decade of modern fintech, let's call it, so from 2000 to 2010, most of the businesses that were getting started weren't actually all that innovative. Wade started his company, Banno, in those days, and a very innovative company, but at the same time, the thing that was getting all the attention was less about companies like Banno that were selling technology to banks. It was more about the upstarts who were challenging the incumbents. So the names that were big in that first decade, of course, people know Square. We had a company called Bank Simple, Lending Club, On Deck, Betterment, and Wealthfront. If you think about all those companies, they were basically taking traditional products. They were taking products that were actually, many cases, decades old. So Bank Simple was a great company, but it was a checking account. All they did was make it digital. And the same thing was true for Lending Club with their personal loans, for On Deck, with small business lending, for Wealthfront and Betterment. They took a wealth management account and they just made the user experience digital. Even Square, with this kind of interesting disruptive dongle that they had that could turn your mobile phone to a payments acceptance device. At the end of the day, they were just doing merchant acquiring in a digital form. So that first chapter of fintech, which was incredibly fun, I don't mean to be dismissive of it, and it had sort of made my career, so I certainly take nothing away from it. But it was really a little bit of a one-trick pony if you lived through it with us, that you just take all the catalog of products in financial services, whether it be auto insurance or lending, all of banking, and think the incumbents are so slow at creating digital access to these products that there's an opportunity to just do that, but fundamentally not transform any of these products. So again, very lucrative, very interesting for me, wildly dynamic, but also inevitable that the incumbents would catch up. I mean, for my money, the best mobile banking app in the United States right now is JP Morgan Chase's. And you could argue that for auto insurance, for instance, despite all the billions, tens of billions of dollars that have been poured into companies like Lemonade and Root and Metromile and on, Geico and Progressive are still the best auto insurance companies in the United States. So notwithstanding all of that, early movement from analog to digital, the fact is the incumbents eventually did get the joke and they caught up. And so for the next decade, the decade that ended, say, with 2020, we needed a new theme. There needed to be something for founders in fintech to do that was truly differentiated and that created much more distance between what a tech-enabled, tech-driven, founder-led company can do versus what a regulated incumbent can do. And the big difference between those two things is software. There's just not a single regulated incumbent in financial services that can make and maintain delightful and sophisticated software. And there'll surely be some people who would disagree with me on that, but not credibly. It is just, in my experience, true. That is what founder-led, technology-driven organizations do better than any scale incumbent, particularly in regulated industries. And so that's what led a number of us, starting about a decade ago, to focus on what has become generally known as embedded finance. So the transformational move in fintech, but really more broadly in financial services, is not, let's make our products digital. That was a necessary step. You need these products to be digital. What was transformational was then embedding them in sticky, data-rich software, so that the way consumers and businesses interact with financial services are underwritten and serviced over time and are acquired as customers. All those critical aspects of the value chain of financial services, all of those over time increasingly take place in the context of software that the consumers and the businesses are using anyway. And as such, those financial services are safer, they're cheaper, the underwriting can be done seamlessly and quickly and with less bias, And the user experience is much more elegant online and in the flow of the work, the jobs that the consumer or businesses are trying to get done. So this chapter, which is we're sort of still in the middle of to a certain extent, although again, everyone gets the joke at this point, is one in which there is much more substantial competitive advantage to be built by founders. Because as hard as they try, what I've observed from a very close distance is that the incumbents will fail to match the ingenuity, innovation, and pacing of founder-led, technology-driven organizations. And so this has been an incredible blossoming of market cap and exciting companies, and the draw of talent to the fintech space has been enormous. You know, I can sort of over the arc of my career in the late 90s when I started focusing on fintech, I think it was like 15 basis points of all venture capital. So meaningfully less than 1% of venture capital went into fintech. And there wasn't even really a term fintech, but let's call it financial services. By 2010, it was about 2% of venture capital went into fintech. And I'll never forget how I felt when it started showing up on the charts as a category. It was like, wow, my life's work seems to be somewhat validated by Crunchbase, oddly. In the peak in 2021, 19% of all venture capital went into fintech. And you could look at it as people did and say, well, look, it's roughly 19% of GDP. And so maybe that makes sense, but you know, spoiler alert, it didn't make sense. and fintech has come back down to the single digits where it likely belongs, but that is still just a massive shift of resources, of capital, and most importantly, of founder and talent energy going into innovation and really revolutionizing financial services. And that is incredibly exciting, has already had meaningful benefits. And that was really, in my mind, unlocked by this second phase of the fintech revolution, which is not just analog to digital, but rather discrete products to embedded products, and allowing fintech to be an ingredient that when software engineers and entrepreneurs set about to build their businesses, when the next Toast or Shopify, when that founder, when she sits there and thinks, I want to build, brand new software to delight the restaurant industry, to overthrow what Toast has built, one of the critical ingredients, you will think, well, of course, this needs to be cloud, and of course, this needs to be mobilely accessible, and of course, it has to have embedded financial services. I will use a company like Moov to create the ability for restaurants to accept payments. I will allow restaurants to make payments, to do all their procurement and accounts payable in the same ledger. I will incorporate payroll. I will provide the ability for small businesses to borrow money with full transparency as to their financials, so the underwriting takes place much more quickly and much more accurately. All of those ingredients of embedded finance, the making of payments, the acceptance of payments, the storage of money, the making of loans, the acquisition of business and personal insurance, all of those things that for someone founding a restaurant were separate, offline, expensive products and processes are now in the toolkit for that next founder who sets up a software package to serve that industry. And that is unbelievably transformational to where fintech has gone from being an industry of its own to being a vital ingredient that every founder uses to build their software and to build their company. Because the monetization, if you look at Shopify, 75% of their revenue comes from financial services. If you go and visit Shopify, it's a software company. But if you look at their P&L, it's a payments and lending company. And that is the other beauty of embedded financial services, is that software is a big industry. But if you add payments, lending, and insurance, it's 17 times larger than software. So when you give software companies the ability to not just charge subscription for software, but also enjoy the profit pools and revenue pools that come from embedding financial services in software, It has a transformational impact on their P&L and their ability to create value and their ability to reinvest in their product and further delight their customers. So this chapter has been a lot of fun, notwithstanding the 2021 nonsense and the reaction to that in terms of a pullback in funding and company creation. We are still in the midst of this embedded finance movement, and there's a way in which, the word fintech, again, one of the benefits of being old is that I remember when I started in venture capital, the thing you wanted to fund, they were internet companies. That was like the category. People would say, what are you interested in investing in? People would say internet companies. Very quickly, that sounded really anachronistic and goofy. Like, no, they use the internet, but they're not internet companies. And more recently, in 2009, people would say, I have a mobile company. But of course, that was just an enabling technology. And I think cloud is going the same way. Like, people are not starting on-prem software companies. Every software company that gets started you can call it SaaS, you can call it cloud, but the fact is this is just how you build software these days. And in our thinking, fintech and embedded finance in particular is sort of that fourth platform to where when you're starting a technology company, in particular a software company, you're obviously leveraging the platforms of the internet, of mobility, of cloud computing, and then increasingly and almost pervasively over time, leveraging these technologies of embedded finance to help build your product and help build your business. And it's equally transformational in terms of the technology model and the economic model. Now, what comes next after embedded finance? In my view, it's decentralization. We actually, despite having an hour, do not have enough time to talk about what you might call crypto, what I generally think of as decentralization, and the way in which financial services and products will be manufactured in the future, not by regulated incumbents, but via protocols and delivered on chain. This is something about which I have enormous conviction. Just don't ask me when. That part's a little harder. But if you look what's happened just in 2024 in terms of stable coins and things like real world assets being brought on chain, you can see the seeds of that next wave of extraordinarily powerful transformation. So that's my sort of potted history of fintech and the arc of it going into the future. But what's happening right now today, one of the things I do, because I work at a reasonably large firm at Bain Capital and I'm friendly with a lot of banks, is I go and speak to bank executive teams and boards of directors. From time to time, they will want to know what's happening. And frequently they will reach out and say, 5 years ago, come talk to me about enterprise blockchain, or they will have an idea as to what the flavor of the month is that they want me to talk about. So I was recently speaking, there's a European bank called Santander, great folks, and I was speaking to their board recently, and they said, could you please come and talk to our board about generative AI? What else? And I sat down with the leadership and they said, we are very interested to know how we should be using generative AI to transform our bank, to make it better. We've read studies from consulting firms that suggest that we should be using it in all these areas, and we want your input into that. And I said, I'm not going to come talk about that. That is incredibly boring. Because the answer is you should perhaps, like in various departments, be using generative AI to lower the cost of customer service or your legal costs or your sales and marketing, copy production. Like, it is stultifyingly boring. You should probably be doing it. I don't want to talk about it. But what I would come and talk about is what is going to happen to your bank when all of your customers have generative AI. And there was this really awkward silence, and they were like, well, I don't even know what that means. What would it mean for our customers to have generative AI? What would it mean for us? And I said, okay, well, let's talk about that. Because in my view, when all of the customers of banks are empowered to use generative AI to run their financial lives, it will be the end of banking as we know it. And that's because of this evolution and the capabilities of generative AI that we're witnessing now in real time. You know, the magic of ChatGPT in November 2022 was this ability to read and write. And that's still largely what we see today, is absorbing all this tremendous amount of information, synthesizing it and outputting it in ways that are confusingly human, in written or verbal or video or any kind of output mechanism now. And it is extraordinary to watch, but it is not super relevant to banking. What will be relevant to banking is when we have generative AI agents that can do things on our behalf without us having to be involved, and can do things in compliant and predictable and intelligent and nuanced ways that take into account everything that the agent is reading and writing. Because banking as an industry is built on inertia. I said this to this board, and it was another awkward moment. If every one of your customers woke up tomorrow morning and did what was in their best interest, immediately did what was in their best interest, how many of them would stay with you? The answer is 0. Because there is no customer at any bank that is being given the highest possible interest rate on their deposits and the lowest possible rate on their borrowings. The whole joke about banking is that they pay you as little as they can and they charge you as much as they can. And this concept is called NIM, net interest margin. It is the predicate of banking. And we all accept this. I didn't discover this in some dark cave. This is from the federal call reports that banks have to report. This is a complicated chart. I'll explain it. This dark segment here is percentage points, net interest margin. It's the difference between what a bank charges for loans and what they pay their depositors, all of us, in interest. And that net interest margin is what is going to go away when everyone in this room and your parents and grandparents have generative AI agents that every day and all day go out and shop for the very best rate you can get on your liquid deposits and refinance every obligation you have, not just your mortgage, but every obligation you have as many times a day as they can find a better rate for. Because the only thing keeping us from doing that is laziness and inertia. It's an incredibly powerful force. I don't say it's the only thing, like it's a small thing. It's also keeping us from doing all sorts of things we should do. But generative AIs can't exercise for you, can't get you on a better diet, but it can absolutely refinance your loans. And trivially, easily, it can move your money around to the place where you get paid the highest interest. And what's interesting about this, this chart, I love this chart so much. This shows the different financial metrics for different sized banks. So you have here on the far right, over 50 billion. These are big, big banks. And then the far left, under $500 million, tiny community banks. The United States has 4,500 banks. I was talking to a founder from Australia. Australia has, basically 5 banks have 85% market share. And I don't know how many there are banks in the country, but low hundreds. That is a sensible banking industry. 4,500 plus another 6,000 credit unions makes no sense. And people talk about these small financial institutions as the backbone of their community. You'll hear this all the time. They have the highest NIM. The backbone of your community is giving you the rawest deal in banking. You are much better off banking with a large bank than you are with your community bank. They pay you nothing on your deposits, and they charge you a ton because they assume they don't have a lot of competition because you're in a small town. That's the industry structure of banking. And that is all going to change because that gouging that happens on the far left of this chart with these small banks, they still don't make any money. This blue line is actually how much net income they have. Banking has gotten so expensive that as a function of your assets, if you're a small bank, you have all these fixed costs. And so even if you're gouging your customers as you are on average to stay alive, you're still not making a lot of money. So this entire left hand of this chart is just going away. And it's going to be really slow and painful and destructive, but like our banking industry is going to look like Australia or Canada or the UK, sensible countries that have many, many fewer banks. And what will happen first will be the rumblings of generative AI and the narrowing of NIM as more and more people seek this digital assistance in reducing how much they pay on their loans and optimizing what they get paid on their deposits. Just a few more data points, and this is shocking every time I see it. Right now, you could buy treasury bills or get a high yield savings account with American Express, for instance, and earn over 500 basis points, over 5% on your money. The average savings account pays you around 50 basis points. It's not a checking account, it's a savings account. Like somebody actually said, oh, I will move money from my checking account to this savings account for 50 basis points. Like that is NIM in action. It's just the inertia of people making bad financial decisions and then never revisiting them. That gap is shocking and persistent. In terms of refis, it's even worse in that sense. If you could, during the era when there were like 0 interest rates, you could refinance your auto loan and on average save 5.5%. So you had an auto loan at 12, you could get it down to 6.5. And 5% of people did it every year. Almost nobody did it. Almost everybody had that. That was the average gap. This opportunity existed for almost everybody, and 95% of the people persisted. And the same is true in mortgage. Only 19% of people, when interest rates went from 3, 4, 5 to 0, refinanced their mortgage. It's a hassle, for sure. But the savings are measured in the thousands of dollars a month, but yet the human behavior around this is incredibly sticky. I don't expect you to go into this, but there's this other type of product that looks kind of like a savings account called an annuity. It's an insurance product that pays you out a rate that's sort of like tied to interest rates. Similarly, when rates went up, that's when you should refinance your annuity, because if you got an annuity when rates were low and then rates go up, you should definitely get out of that old one and into a new one. Only 19% of the people who could do so without a fee or penalty did so. I include this because A, it's not just banking that's going to be screwed, and B, there's something interesting about this 19% number. That sort of fits, like 1 out of every 5 people I know has got their act together, more or less. Sadly, I'm not one of them, but I think there's like it was like when there was an old fintech company called Mint that was like a budgeting app. I don't know if people remember, 15 years ago. And the thing grew like crazy, ended up getting bought by Intuit. And I remember asking the CEO why he sold, and he was like, basically only 1 in 5 people are ever gonna use a budgeting app because the rest of us don't like to budget. I was like, there's something about this I got 6 kids. I think probably 1 1/4 of them would use a budgeting app. This is human nature. So NIM is going away. It's going away because laziness is gonna get solved by generative AI agents. It's also going away because latency. It used to be the case that like you might worry about moving your money around to optimize for interest because you'd be ACHing everything around. It would take 3 days and you wouldn't know when it was gonna happen. So you had to keep a big buffer. But now, again, thanks to companies like Moov, we can all create solutions that are built on top of FedNow and real-time payments such that you don't have to have like some mystical prediction engine. You can move money exactly when you need it, exactly at the right time, and have way less of this cushion slippage around I need to have money in low interest yielding accounts simply because those are my transaction accounts and I need the money there. And then finally, opacity, like you might not have known historically what your best options are unless you were marketed too aggressively. But now, even in the United States, we will eventually and soon have legitimate open banking such that these 3 barriers, these 3 things upon which the entire US banking industry has been built of latency, opacity, and laziness are gonna be a thing of the past in 3 to 5 years. So I think that'll be interesting. I think it'll be good for technology companies. I think it's a really exciting thing for founders to get ahead of because banks are gonna need a lot of help dealing with this world. And there are opportunities to build really interesting businesses as this transformation takes place. But There are some other things happening in banking land. You know, this slide is about banking as a service. And one of the things that fintech relies on is this layer cake architecture where at the top you have these software companies and at the bottom you have these banks. And somebody needs to make that all work. You can't actually, until my decentralized world comes into being, you can't actually hold money if you're not a bank particularly well. You really can't move money without being a regulated entity. You can't do things like make loans in most cases without having a bank in the mix. And so we created this architecture where you had these sponsor banks that basically allowed technology companies to act like banks. And the US government has sort of decided that's not a good idea anymore. And so we're going through this paroxysms of figuring out what kind of architecture does work. And this is where I would just say, find yourself a modern infrastructure partner if you are building a fintech company. You know, there are a lot of companies that stayed with some legacy vendors that had not future-proofed their system for likely regulation, that had not built modern reporting and modern ledgering and built an infrastructure of banks who are robust, scaled banks that could provide services and survive regulatory review. I'm not going to name any names, but it's been a really rough year for customers of these legacy infrastructure vendors. And so, you know, our view is that partner banks are here to stay, that ultimately the US government thinks fintech is a good thing, but the safety and soundness of the banking industry is important to them as well. And so the survivors of this kind of horrible year for BaaS will be the modern companies that have sophisticated founders who understand banking as well as technology. And, you know, that has been a hard road for folks. I'll skip this slide. I want to get to this. I might go back and cover some of that stuff. Those slides I went through were sort of implications for banks, but I want to cover something else first, because this banking as a service thing, you know, it's actually kind of emotional, because, you know, founding a company is like an identity level choice. People who are founders, people who are early employees at technology companies, they identify themselves with their companies. And as an investor, I get drawn into that too. And so it's not just sort of dollars and cents and, oh, I'll just get another job. It's more, you know, I started this company because there's a constituency out there that I care deeply about. I want to build a solution that solves a huge problem for them. And when that's the motivation, when you get into the turmoil that for many people in many parts of fintech ensued this year with this regulatory action against sponsor banks and the challenges that some of these legacy banking as a service vendors caused, it reminds me of this hero's journey. This is a concept articulated by a guy named Joseph Campbell, who was, I think, one of the leading thinkers of the 20th century. He wrote about the power of myth and these iconic stories that we as a species have told each other and told ourselves for thousands of years, and how there are these recurring patterns in these stories. And this story is one of the most common. It's the hero's journey. And you can look at these phases on here, the call to adventure, the meeting a mentor, and think about Star Wars. Think about Harry Potter. Like, the iconic stories to this day are following this pattern of a young, often young hero who is called to do something challenging, who finds help along the way, who crosses a threshold from the normal world into a world, a magic world, a world transformed, and then it gets hectic, inevitably. And there is this bottom. Campbell calls it death and rebirth. That may be, you know, a little dramatic, but I think a lot of people might resonate with that this year. Or maybe they resonated with it in 2022 when the bubble burst and everything felt like it was going to hell in a handbasket. whatever your journey, there will be a moment where you feel like you're at the bottom. And for some parts of fintech that rely on banking as a service, that rely on sponsor banks, where there's this uncertainty, it sure does feel like one of those moments where you started a company, you went into this magic world, you are attempting to transform an industry, you have found mentors and helpers, et cetera, like gotten pretty interesting, and then you hit this rough patch. And that is true, again, for many meaningful segments of fintech. And so, I developed this to talk to a set of founders in fintech, 80 founders. We got together and had a closed door session about like where we were and how we get out of it. And this chart has a characteristic shape. It has a bottom, and then you come up off the bottom. And there is an enormous amount of hope in this narrative. And that is because this is the human experience. And so I sort of populated this chart with what I see happening now for fintech founders as we collectively rally from a very challenging experience for many folks going through either the hangover from 2021's fintech bubble or perhaps or the banking as a service crisis that is this rumbling mess in 2024. And by the way, this probably applies to some crisis in 2026 and 2028. This is life. There are a lot of different bottoms. But this particular one, you can already see the beginning of the upswing. We are going to go through a moment where financial regulators, get very aggressive. Regulators have this habit of fighting the last war, because it's the only one they know how to fight. If they could fight the current one, I'm sure they would. But Silicon Valley Bank was very embarrassing. And so there was all these reactions to Silicon Valley Bank and its closure last year. It feels like 7 lifetimes ago, but it was just last March. Right now, the regulators are very embarrassed about the collapse of Synapse. And there will be new regulations and there will be new aggressive actions by regulators. And we all sort of have to get used to that. And one of the things that will happen is that this idea of a company like Synapse that is a middleware company that seeks to pretend that there's no connection between the bank and the technology company, that model has gone away. What we need is sort of straight through ledgering. And thankfully, there are enough companies like Moov who are on the right side of history. But again, look very carefully at who your partners are underneath you in this world, because that old model, that Synapse model, multiple ledgers, potential for chaos, this is where the regulators are going to focus. And so the key is to find partners who, as I say here, can do both. This is an enormous part of this hero's journey, actually, is about synthesis, another really important idea in the history of philosophy. And too much of fintech history has been about fin or tech. It has been about companies repudiating the need for incumbents, or about incumbents saying that fintech is bullshit. And the fact is, because of the regulators, because of customer demands, because of where the world is heading, the solutions of the future are going to be a synthesis of legitimate banks who are sophisticated enough to actually engage, and technology companies who are sophisticated and experienced enough to speak bank in ways that comfort banks and comfort regulators. And again, Campbell is such a genius. He has this concept at the sort of success end of this circle that he calls the master of two worlds, which is to say that in so much of life and a human endeavor, the road to success is about synthesizing two hard concepts. We've all seen this in our lives. You see it in all of the major stories that humankind has told itself. And surely fintech is no different. We need this synthesis, and that will be, for the industry, the road back. And I'm personally very excited about that. Again, it says here on the right here, there's a little word there on the bottom right, it says helper, right, with trial and failure. And that's where I identify myself. I don't get to be the hero in this hero's journey. It's totally fine. But my experience is that heroes need helpers, and the beautiful thing about venture capital is, you buy a ticket to the ride by investing in the company, and then you just answer your phone and your email and your Slack and your WhatsApp, and you show up when you're needed, and it's incredibly rewarding. So most people in this room are more on the hero's journey themselves, and that's incredible. And I hold you all in massively high regard. The fact that you're here means you're making sophisticated choices about your financial infrastructure that bear in mind the fact that, cycles happen. There are bottoms as well as tops, and I'm glad of that. And I just wanted to share this because, there's an aspect of a conference like this that is not just about the content, not just about the networking, but it's about something that Wade and his team have invested in from the very beginning. It's about community. Because one of the benefits of specialization, one of the things that I found so valuable, to take it back to the beginning, in the mid-'90s and in the late '90s, when I decided to focus on this incredibly niche thing. It was niche, but it wasn't literally just me. There were a few handfuls of people who also cared, and there was nothing like the energy that came from getting some number of handfuls of people. Okay, maybe we've got more than a few handfuls here, but a band of people together who view themselves as passionately interested in subject matter that is different from what the rest of the world is thinking about. That, to my mind, is how you build community. And that community is how you get through the hard stuff. And so I applaud you all for being here, and I'm thrilled to be here myself. And so I'd like to wrap this up now, rather than talk about how banks can react. I'd rather end on this higher note, and just say, let's hang together through this. If anyone needs to get a hold of me for anything, any help with any of these topics or anything, mharris@baincapital.com. Being of use to the community of fintech builders has been the most, exciting part of my career, and being here today is another example of that in a way that I find very fulfilling. So thank you for having me, and I hope everyone has a great conference.